some of the best seasonal spreads. Back in the early and mid-'80s, the early '80s, I wrote a book on spreads that Windsor Books sells on seasonal spreads. And then in the mid-'80s, we came back and researched them again. And we found that some of these spreads are very consistent and they work almost 100% of the time. Others 60, 70, 80% of the time. So there's a certain reliability factor involved when you get into seasonal spreads. I'm just going to mention some of them, and they're also indicated in the manual. There's the buy. This is a back spread where you buy December and you sell the nearby July cotton. And what happens is you do this in the spring, and as July's about to go off the board, it tends to get weak in the summertime as there's an abundance of supply and it goes down faster than the December does, and as a result you have a profit. Another good back spread or bear spread is you buy December and you sell July corn. You buy December corn, you sell July corn. There again, you hold it right into the delivery month in July. In midsummer, corn prices tend to get weak. July goes down faster than December does, and again, you capture the profit. Another example of a back spread that's consistently profitable and is a seasonal spread is you buy December wheat. Let's say this is 1998. You would buy Dece 98 wheat. You would sell May 98 wheat. And as May goes off the boards, as you get into the delivery month, again, it tends to go down faster than the December will. And as a result, again, you have a profit. One of the most profitable spread seasonal trades involves the old crop and the new crop in soybeans that I mentioned earlier. Again, it's the back spread, the buy November and sell the nearby July prior to July going off the board. And the July tends to go down. You notice that a lot of these are in July, and it's not an accident. It's just that that's the summertime when these agricultural commodities tend to be brought to market, and that's when there's an abundance of supply, and that, on a seasonal basis, tends to drive the prices down. And the nearby, of course, without the limits, will go down faster than the back months. Another back spread is to buy July oats and sell May oats. And here, because oats isn't a very volatile commodity, the margins are very low, maybe $200 a spread. And you get, if you have a $200 spread and you get 4 cents, $200 margin that is, and you pick up 4 cents, we just picked up 100% on your invested money. And you don't do one, of course, you can do multiples. The most consistent spread in the research I did on my spread book had to do with the pork bellies. And this not only worked 100% the first time we researched it, but it was 100% when we went back as well. And as far as I know, it's still doing very well. And that's the buy the May pork bellies and sell the February bellies. So again, it's you're buying the back month, you're selling the near month. February comes before May, and again, there it tends to go off weak. Spread trading and seasonal spread trading in particular tend to require a lot of patience. So if you're a hands-off investor who's got another job and you just want to watch it in the newspaper, you can put on these spreads and just stay with them for months at a time. And somebody said spread trading is a lot like watching paint dry. It's very boring, but it's also very consistent. So that's certainly one approach, is to just put the spreads on, let them work, and then get out after a period of time. This has the advantage also of having very low, not only low margins, but low commissions, because you're not trading in and out all the time. Another thing to think about when you do a spread trade is to get in and out of both legs at the same time and keep it a spread. What some people tend to do is say, well, you know, it's up today, I think I'll take profits on the long position, and then when it comes down, I'll pick up a few more pennies on the short. If it doesn't do that, of course, now you're doing outright position trading, and you're much more vulnerable to what the market does. Whereas if it's a spread, all it has to do is widen out for you to make money. Spreads offer diverged strategies as well. I mentioned that they have lower margins. You have both normal seasonal patterns and contra-seasonal patterns. The normal patterns, of course, occur most of the time, and occasionally you have a disruption in the fundamentals where, for some reason, things get out of line and the opposite occurs. And you need to be aware of that if that might occur. You don't want to ever use a spread to protect an outright position, and this comes up especially with novice traders. Let's say they're bean traders and they buy beans and it starts to go against them. So what they do is the broker says, well, let's sell a back month in beans and that'll prevent further losses down. But what it does is it locks in a loss that you ultimately have to deal with, and it's not really a good way to use spreads to lock, because all it's doing is locking in a loss and putting off the day of reckoning. It's better just, if you're trading outright positions, just to get in or out. You don't want to assume that spreads are automatically a low-risk trade. I had a lumber spread one time where I was long July, short Nove. The July went down, the Nove went up, and I ended up losing on both sides. So they're not necessarily limit in risk and low risk, but they can be. Now, I mentioned that the seasonality is important, in that the contract months tend to trade in a stair-step fashion. So if you're in March wheat, for instance, and it's $4.50, and it's a 12.5-cent month carry, May will be like $4.75, July $5, September $5.25, and December $5.75. That's the way. That's called that's the normal pattern that the contract months will trade in. This is why they trade it at higher prices as you go out in time, because it costs more to store the economy, to borrow the commodity, to borrow money, to hold it, and so on. So what you have is that stair-step pattern, and again, it probably won't be at full carry, but it will be at some portion of it. So if it's at 12.5 cents and maybe full carry is 15, then you're really risking that 2.5 cent difference between 12.5 and 15. That's your downside risk, that 2.5 cents. However, what will happen, again, if you get a bullish situation, the nearby March, which doesn't have any limits, may skyrocket in value in terms of the back months. So if you're long the front month, short the back month, and you have one of these tight supply situations, the risk-reward becomes very, very favorable. You're risking literally a couple of cents to make 20, 30, even 40 cents on the trade. So look at the ratio of the risk versus the reward.